All right, all right, all right. Good morning, everybody. Good morning, John Walkup.
Hey, good morning, Noah Rosenblatt.
It's a very good morning out there. A little cooler than we usually are this time of year.
Oh, it's
Nice,
great.
though.
It's great. My
Totally.
son had to go to school early this morning, so I was out. I mean, we left the house at 6:30. Like, I don't know
That's
what's
early.
happening, but I mean,
Yeah.
early bird
It's
get the
beautiful
worm.
out.
But it was chilly. It was
Beautiful out
chilly. I
there.
was kind of like I could use another layer. I had like my quarter zip on. I was like, I'm chilly. I'll be honest. It's like an Adirondack summer morning, which is
Yeah.
awesome, and I hope it continues.
Yeah, we hope our market doesn't go chilly. That's for sure. So let's get this going, guys. We were just waiting a few seconds for a couple people to log on over here today, guys. Just a reminder, we love to hear what you guys have to say. There should be a live chat right over there in the YouTube live stream as we're going. We are on delay about 20, 30 seconds. So we'll do our best to try to keep everything timely. Okay. But if you guys have a thought on what we're talking about here, I am sharing my screen. Just let me know. John, can you see my screen okay?
I can see it, and I don't have any comments for you just yet, but I'll save those for after the
Okay.
show when the knives
Let's
come
get
out.
let's get going. Good morning, everybody. This is John. Welcome over there. I am Noah Rosenblatt. We're both at UrbanDigs. This is Macro Monday, so you guys are gonna get a little Macro Monday coming right at you. For those of you that are new to the show, we're gonna start out with Manhattan real estate. We're gonna go to a couple of macro topics there at the top. Check in on rates, check in on credit spreads. Interesting things going on there for sure. And then we'll try to circle back to Manhattan real estate, maybe try to get an actionable takeaway or one or two, given where we are in our seasonality. And John, let's just start out. I'm here on the ticker market snapshot. I'm clicking on 1 month. We usually do this first over here. And I want to start with 30-day supply, guys. I'm looking right over there. 30-day supply, 1847. We're supposed to end the month at 1544. So right now we got more supply, generally speaking, entering our marketplace than typical. And when I look at contract signed, our measure of deal activity, we're at 963, and we're supposed to end the month at 1123. Those are our norms for the month. So supply, more stuff is coming on, less stuff is going into contract, more stuff on, less stuff in contract. That's what this is right over here in the market pulse. Basically, the April slowdown. Call it what you want, Johnny.
Yeah, and I guess so supply is doing one thing. So supply is definitely over, and supply has been pretty much sticking to its traditional seasonal script. It's not really. It's higher, but you're not seeing any sort of sharp deviation, which would make you think like, oh my gosh, we are oversupplied. I think the real question for me is looking at contract signs and trying to get an understanding. So we like to measure our demand levels in terms of liquidity, like the 30-day pace. So the question is, when you look at that 30-day pace, what is that 30 days made up of? In other words, what's coming out? What was 30 days ago? This thing be coming out, and what's the next few days that are coming in? Are we going to right the ship and get up to 1100 by the end of the month, or do we have some big numbers coming out and are being replaced by lesser numbers?
Yeah, I don't know, man, because rates are going up right now. It's going to make it tough, I think. I know we got a lot of cash purchased in here, but when I look at liquidity, that's this chart in the bottom right here. That's that deal volume. We're just kind of meandering and going sideways over here. I was hoping for a May bump like 2023, that return back up there, that little pitch up. But so far, I got to be honest with you guys, I'm not seeing it. I'm just not seeing it. So that's why this seasonality is going down, is because we're supposed to see it this time of year. And we're not. This is relative to seasonality. So slight underperformance trend in the market. If you guys are 2-3 weeks ahead of us, ahead of data, hopefully you're seeing something out there that we're not, and gives us a push. Okay. Yeah. So it might be a weaker close to the spring season. Plan accordingly. Okay. Plan accordingly. All right. Any questions, Johnny?
I don't have any questions on that. I mean, I think this is one of the things that we talked about in sort of the weekly updates, is that May bump that you're talking about, which usually happens, right? Usually March is the busiest month, a little bit of a decline. It's in April with the holidays and whatnot, spring breaks, and then it bounces back up in May. We had a little sign of that, and it kind of fell back down. So I think the jury is still out on May. I'm hoping they come back with a guilty that this market is great, but we'll see. We have to see.
All right. We got a couple of weeks. Let's move on to credit spreads, guys. I'm going to go refresh this page because we just got an update coming on here. This update's right around 10:30, 10:45, hopefully right before 11 o'clock, Macro Monday. Guys, we look at credit spreads. What this is the difference between corporate bond yields over here, safe 10-year treasury yields over here. Both of them are always moving one way or another. And we're looking at that gap. That gap in between. Is the gap narrowing? If the gap is narrowing, let me click on the max bar here. Look at the blue. If the gap is narrowing, that means this is going down, which is a good thing, which means this credit spread stress indicator is going left towards the low stress level, which is a good thing. Again, that narrows and basically means risk on. Okay. But if that gap between corporate bond yields and treasury yields widens, that means this is going up, and that's a negative thing and could affect the markets accordingly. Now, if I go to 6 months, okay, I like this chart because it shows everything of what we just went through, right? It really shows that whole April bump up in credit spreads correlated with the risk off in the markets. There was a period of a couple of weeks in April where everyone was really worried, a little scared, maybe a couple of days of panic here and there. I don't know. I don't know how much the market shifted in April yet. We got to wait till probably August to get that sales data for April bids and April deals. But credit spreads have come down. We're basically just at the high level of where we were before, Johnny. And it seems like risk on is kind of back in the markets. We'll see how long it lasts for.
Yeah, I think that's sort of a good summation. My only concern is, look, we had a big rise in April on the back of the tariff news and the uncertainty. I mean, the equity markets were down 15% at one point, so that's naturally going to work its way into credit spreads, and they were certainly rising and rising quickly. They've backed off, but as you mentioned, they're sort of back to where their highs prior to this is. So I think they're sort of hanging out at a new neutral, and I think the takeaway for me is that they're still undecided on which way to go. And I think the news on Friday that Moody's cut the credit rating for the United States from AAA to AA, to me, that sort of suggests to me that's a lagging headline. I think the work that went into that was multiple years ago, and they're finally getting around to doing it. But the question came out, and the question I have is, all right, well, if the U.S. credit rating is now not AAA, well, what is everything else? Does everything else have to get readjusted? And I actually went out, I asked some friends who are in the credit markets, and they essentially said that the US's credit rating was a split rating, I guess. So there's like a AAA and a AA. So you kind of take that risk. And besides, the US's AAA rating is it's by de facto, it can print its own money. So it's not really going to affect the credit ratings of other things. But credit spreads, I would expect here, I think the bias to me is higher than lower at this point.
I disagree.
Everything that's going on.
I disagree. My take on credit spreads is that basically we're going down. We're narrowing back down. A risk on period is going to. I think we're just going to hang around this level, which to me would be fine. That's almost like a risk on thing. As long as you're not going up on this thing, I don't know if now's the time when this is going to go back up again. I don't know. The markets handled the tariff situation a little rocky, but it got through it, and we're just off of record highs in the stock market. And I got to tell you, the pain trade, I talked to my buddies in Wall Street, and the pain trade's up. Nobody believes this rally. We talked about this last week on Macro Monday. Nobody believes this rally. The pain trade's higher. It could be the most hated rally. I think there was a headline. I said that a few weeks ago. It's been the most hated rally in history if this rally keeps going and no one believes it. So for those reasons, I kind of think it's going to go. But we'll see. This whole debt downgrade of the U.S., I think we've been here before, right? I don't remember the year, but we've been here before. I don't know. It feels kind of like a nothing burger to me. And you know what? If the United States debt situation is poo-poo, then we're the best smelling poo-poo out there, because everyone's situation's poo-poo. You know what I'm saying, John? We're king of the
well,
poo-poo.
I don't know if I continue in this vein, but I'm going to disagree with you. I think that the macro environment is weakening to a certain extent, and I think that yes, there's certainly a rally going on, but I think the higher rates go, whether that's the 10-year or the 30-year, 10 years over 4.5%, the 30 years over 5%, the less attractive equities become, the more attractive bonds become. More money is going to flow out of the risk assets into the safer, quote unquote, safer assets. And, at the same time, you're starting to see some evidence of what are called unanchored inflation expectations, where consumers are expecting prices to be higher, not by 2 or 3% next year, or rather, I should say in the following year, but 5, 6, 7%. So you're starting to get some of these inflation expectations turning into reality, even though the inflation actually didn't happen. So, right, the tariffs are on pause, or maybe there's a deal and whatever happens. However, prices are starting to rise, or rather consumers think they're starting to rise at the same time that they think the economy is not so great. So I think you're starting to see a little bit of a consumer slowdown. I'm hoping that doesn't necessarily manifest itself into the Brooklyn and Manhattan markets, because I think that real estate is a different bag altogether than the risk assets. But I tend to think, bringing this back to the credit spreads, I think they're biased to the upside here rather than the downside.
Okay, well, totally noted. We think a little differently. I don't know. I feel like we're going to hang out here, maybe even go a little lower, but let's just see what happens, guys. We check this every week. Okay. Right now, my takeaway, it's credit spreads are down. This is the 1 month trend in credit spreads. They're down and they're just staying down right here. I don't see any signs of going up. Johnny, we'll see what happens. Let's shift to the rates. You mentioned rates, John. You mentioned rates, and this is the story, guys.
I mentioned a lot of stuff.
Yeah, you did. But this is the story, guys. Yeah. This is the story with the rates. Let's just do first what we usually do on this page, which is what does the market expect for cuts? Okay, and what do you need to know? We use this page. This is let me scroll up. This is the FedWatch CME Group FedWatch tool. I'm on the probabilities table on the left. Okay, hopefully you guys are getting used to this. We are here. And again, guys, gentle reminder that mortgage rates move without the Fed doing anything, right? I mean, they move because of this, because the market's changing what they think the Fed will do. That's mortgage rates moving, right? It's not the Fed doing anything. It's the market perception of what's going to happen. So we are here. Next meeting is June. No move. Pause. Okay. Then you got July. No move. Pause. First cut September. We got two cuts. First cut September, 50%. I mean, it's not very high, John.
Oh, it's a coin toss. It's a coin toss. So you got 20. No you got a bit of a decent discrepancy rather between the probability. So it kind of suggests that there's going to be a cut, but it's undecided at this point what that cut's going to be, or if it's actually going to happen. And
it's not a high percentage.
Well, I just want to go back to what I'm talking about earlier. So now there's the rise of the new talk of the bond vigilantes coming out, and essentially, what is a bond vigilante? Basically, they're going to push rates higher because they don't necessarily like the fiscal direction that the country's going. It's just like, all right, you want to cut taxes and spend more? Great. We're just going to charge you 5, 6, 7% on your long-term dated bonds. So that tends to force the government's hand. And I think we're starting to get a little bit of that flowing into the shorter term numbers here. So I have 2 points to make. The first one is, remember how this was all over the place? Like, this is all the way down to 1% even. I mean, was it 6 months or so ago? We were starting to say, oh my God, we got 7 cuts coming on. And now we're back to the place where there's maybe 1. So that whole shift is it's interesting to watch that happen. And the second is, I mean, to your point about, I hope you guys are, understanding this and, getting a sense of it. The other thing I hope a lot of people get the sense of is how much and how often these markets are wrong, and how often they update and change their forecast. So it is just all over the place. And so anytime you get some expert opinion saying, oh, we got 4 cuts coming the next year, that is as of this moment. And then, in 10, 20 seconds, that could be changed. So
that's why I think you guys
take off the conscious a little bit. You got to be conscious of these predictions.
That's why I think you guys, when I say you guys, I mean you agents out there that are listening to this, whenever you get into a predicting interest rates conversation with a client and they're asking you, especially if they're Wall Street and they're asking you, they probably know the answer. They're probably just testing you to see what you're going to say, a little trust test kind of a thing. Here's what you say, guys. Well, I keep an eye on the Fed Fund futures market. That's what this is, the Fed Fund futures market. And just talk about this year. Right now, they're pricing in 2 cuts this year. That's it. September and December. That's what you need to know. Okay. And I got that. I could see it right here. That's the first cut. Let me see if I can delete this somehow. Okay.
I don't know, man. I don't know if I'd be talking about rate cut. Just
devil's
advocate here. Even what the market is saying, I would be like, I don't know where they're getting it from.
Don't talk about rate cuts. If you find yourself in a conversation with a client asking you, what about rates? What is your response? You don't have to think about it. Well, I keep an eye on the Fed Fund futures market, and they're pricing in 2 cuts this year, 1 in September, 1 in December. And quite frankly, they're low on the percentages, 50%, 38%. That's not high. You wouldn't bet the farm on that. That's it. That's all you need to do. And
Well,
it changes. You're not giving advice.
A month ago, we were looking at a cut in June, and then June's off the table, right? So now it's
doesn't matter. Doesn't matter.
No, that's my point. That's my point.
It doesn't. This is what the market's expecting, right? Next week they might be expecting something else. The week after they might be. All we can do is follow what the markets are expecting, and we are in a volatile interest rate environment. It's going to go up. It's going to go down. These numbers. Where it ultimately ends, as time goes on, these percentages will go up, and where it ends, all I know is that we'll be all over it. So that at the end of the day, we're giving good advice, right? But I wouldn't go initiate conversation. I wouldn't go write articles on interest rates. That's for sure.
No, I just think it's interesting to watch and just interesting to sort of understand how, for lack of a better word, wrong these markets are on a medium long-term basis. They're very good at the short term, but long-term, it's like, wow.
Whenever you're predicting something a year out, it's just like, come on. I mean, how right are you?
Well, but I think that speaks to the general level of uncertainty out there that you can't necessarily be right all the time. Like you can't count on it. So
yeah,
it's harder to make decisions in that sort of environment. And I just want to bring back, so I'm supposed to watch the comments. That's like my one job. I forgot to watch them. I'm watching them now. And I want to go back. There was a comment that came in. We addressed about the June rates. What happened to, someone's asking, what happened to the June cut? June cut's off the table. It's gone. It's gone. I think.
And that's exactly what John was saying. John, right. 3 weeks ago, it was on the table. Now it's gone. That's why you have to say, well, what the markets are expecting now is this. It's subject to change.
Yeah. And then Brian, I'm going to call him by name. Brian Morgan writes in, and I don't understand this question, Brian. So I'm going to have to ask you to elucidate it a little bit. He says, it's almost like a $10,000 pyramid. It says, the story is Utah. So I don't know. It's sort of like a cryptic. I don't get it, but I'd love to hear more about
the game show, $10,000 pyramid.
Yeah, when they had like the password is burrito.
Yeah, that's kind of terrible at that show. To me. Yeah. I'm curious what Brian thinks, or maybe Brian could write that out. But I mean, I know Brian has thoughts on this stuff. But the bottom line is, guys, less and less cuts. Two cuts.
I'm surprised. I'll be honest. I'm surprised I'm surprised we don't see hikes on the table. I've been surprised by this. I would not be surprised to see them, but right now they're not.
I think it's coming. So what John is talking about when he says that, I don't know how to delete this. I don't know where my delete button is, but like, why is there nothing out here? Like, why is there not 450 to 475 and 475 to 500? There's no columns over in this section here. That's what John's talking about.
I think we'll see. Maybe I think next Macro Monday we might see a column, especially if the longer term rates and the 10-year stay where they are higher. So we'll see.
Well, let's move on. Let's move on from rates. I mean, this is what, guys. Look, this chart is really showing you what's going on. The 30 years hit 5%. So mortgages are going to be probably above 7%. How much it impacts Manhattan? We're a cash market, luxury sector. I don't know, but you're 2 million and under. I mean, you probably might be seeing some stuff right now. I don't know.
Well, I think it's a question of what are the thinking points or the thought points, the processes around buying an apartment. And I think under 2 million, you might be more interested in what mortgage rates are doing, but you're also probably interested in what rents are doing. And rents are at record highs and probably going higher into the summer, and that's a huge factor.
And so is prices, guys. I mean, we wrote a little thing about this somewhere. I think price action and rental action is now going to start hitting some record levels. That's what's going on right over here. Look at this. Look at these prints. Look at that print. 346 sales. We're at 1,500, and that's April. That's February, January, February's market. So we got April, we probably got May, we might even have June. June will reflect March. March was good. April, you got to wait till July, August. So we got a couple of months of record prices with record rents. Crazy. Where am I over here? Crazy. All right, so rates are going up. John, investors demand extra yield to hold longer-term U.S. debt. This is what you were talking about with, sell America kind of thing, with what's going on with the big, beautiful bill.
Well, I think that's part of it. And, the big beautiful bill, I think they're struggling to push it through. But the idea is that it's going to demand more from in bond investors and credit investors are demanding more from the government in order to get this bill through. So they want to see more of a premium. So what is this premium? It's not really a number that's published. The New York Fed pushes out a number. It's basically a derived number trying to understand what the premium is for holding 10 years. it's rising. So you can see the idea is like, all right, if you want me to hold this money for 10 years, and I expect this rate is going to give me this much of a premium. Right now it's high, but it's trending
Relative.
higher. And I guess that's the key. Yeah.
That's the thing, guys. It's people are demanding more money in return for their money. And guys, this is not just a USA thing, guys. This is a global thing. Now, when you think about where we came from in 2020 and 2021, clearly, relative to that period of time, rates are going to be higher. But like they're starting to get like to highs. And how the market reacts to them, I don't know. We're okay now, but at what 10-year rate is the market's going to start puking again a little bit? I don't know. 5.5. I don't know. So that's the kind of thing we got to start thinking about right now. It's probably approaching those directions. It's a global thing.
Yeah. Well, so that's a great question. I just want to bring in one more idea, which is that there's certainly a market. When we talk about the markets, right, we're usually talking about the S&P. We're talking about the equities market. These, I believe, are these. What are these charts? I know this is
you
rising
got
rates.
Australia, Belgium, Canada, Germany, USA is in the bottom right. It's all the countries, all their rates, their sovereign rates.
Right. So rates are up, markets are up, and the idea is that at some point one of these is going to be right, one of these is going to be wrong, because you usually don't get them working in tandem like this. And I guess the question is, real estate is not necessarily a risk asset, right? It's more of a hard asset, I would suppose. So the question is, for people who are interested in buying real estate, and especially that 2 million and under. Oh, I'm sorry. I have to take time out to acknowledge Brian's clarification on the stories Utah. It was a Fletch joke, and we missed it. I mean, he says, "Come on, guys. Yeah,
I gotta go watch that movie again. That classic.
Take a refresher. I need a refresher course. There you go.
Yeah.
Fight fire with fire." Getting back to my point is that if you're interested in buying real estate, I think you also have to consider the wealth effect. And so as rising rates get to some point and equity markets start rolling over, which could be the case, it's not necessarily people are poor. I mean, in a sense they are, right? But that it's that emotional effect of, well, gosh, my portfolio is down 10%. So even though you're not going to sell it for maybe, 20 years, or you're holding it for retirement, you feel like you can't afford stuff. And I think that might affect the market. So I think we got to watch that angle as well.
Yeah. It's just an interesting moment in time of what's going on around the world. And let's just go back to housing, guys. I want to go back to housing because I want to just, I keep reiterating the same point. I'm sorry if I'm repetition, but guys, the bubble is not in housing. It's going to be in something else. You never know at the end of the day, but if we're going to have a risk off scenario, I just don't see housing structurally. And this goes back to the New York City investment thesis. By the way, if you, we talked about that with Noam Newman on Thursday, why the New York City investment thesis is back in play. We gave you 6 bullet points of what you can talk to your clients about, and we'll put that up on UrbanDigs. But when you break down total debt by delinquency status, and you look at the housing market and all that kind of stuff, I tend to like to look at the orange and the red. 30, 60, 90 is a good leading indicator. It's going up, definitely going up. But, you're not going to get to the great financial crisis level. I really don't think. And the 120 days and the red, kind of on the lower end of this whole spectrum from very low levels. So it's going the wrong way. But I don't know if this is something that's going to, again, cause a bubble of what's going on, because structurally, this is not a lot of supply.
Well, yeah, and this is a great point, because I think there's a lot of reform done in and around the mortgage industry after the Great Recession, which I think has really sort of kept a lid on some of the more speculative purchases out there, which are sort of the first ones to go in any type of downturn, which just adds to supply, which just pressures everything. It's just that cascading domino effect. So you're right. I think, credit where credit is due. I think the regulators stepped in arm in arm, I suppose, with the mortgage industry and really helped clean up a lot of that. And so we're dealing with a lot less speculative stuff, which hopefully will be positive going forward.
Yeah. That and the psychology of going through the great financial crisis affected a lot of kids. That's what happened. And they're making smarter decisions when it comes to housing these days. It's just completely different. The building is somewhat restricted. The affordability index. I mean, that's one thing I guess you could say is a little troubling. A lot of people can't afford, but what are they doing? They're renting. This is what Noam Newman's thesis was. is that they're renting. Everyone's renting. Same thing in New York. They're renting. And the rental market's going to just have its moment. And that's kind of the thesis, really, in New York City. This is a 1 or 2 year rental parabolic shift. And then after that plays out, the shift from rental to sales will occur, and the sales market will have their moment. It's an interesting thesis. But affordability across the country, guys, it's not easy. It's high, given what's going on. So they're renting. Okay.
Yeah.
And
well,
John, you gave
me. Well, I just want to go back. The affordability curve has been rising, and I think we talked about this the last one, that median age of home buyers has shifted from like 31. It's like now it's like in the 50s. It's rising. And that's not a great thing, I suppose. Like sort of all funnels back into affordability. I think you generally want housing to be affordable, to have a liquid market. And that's, as brokers, that's what we want. We want a liquid market. So we don't want it too tight. So
yeah, we've seen a non-liquid market, and that's not good. We want transactions. And then to further the point of how look at U.S. housing foreclosures is, again, it's structurally there's just, a lot of equity in homes, a lot of sub 3% rates, 4% rates. It's delinquencies rising, yes, but low levels. Foreclosures rising, yes, but very, very low levels. It just doesn't look like housing is going to be that moment. And you're going into an era of like potentially hard asset searching. You know what I'm saying? Like with this inflation and with fiat and with where debts are. So
look, I look at this. I look at this chart. I look at the one before about delinquencies, and I'm not surprised to see it rising. And I wouldn't be surprised to see it rise even higher, especially if you get into an environment in which, generally speaking, the cost of money, whether that's credit card, auto loan, whatever it is higher. There's just going to be less money to be spent, less money to be shared. Costs are going to go up, and so even though you might be on a really low mortgage with a fixed rate, over time, you might just have to split that pie more ways than one. And so I would expect that number to rise. And I think the long-term average, I think we're still well below it, but I wouldn't be surprised over the course of the next several years, as rates tend to rise up, which kind of seems to be the trend, to see more and more foreclosures hit. It's a sad stat, but I think that you can look to history to kind of see that we're below trend, and most likely we will revert to the mean.
Yes, and that's okay. But that's okay. Like, reverting to the mean and getting back to your own place, that's okay. What we don't want is another repeat of 2007-8. You don't want one of those kind of crises. And I don't know. I just don't see that happening. And just to bring this all back to Manhattan real estate, guys, at the end of the day, it's really a story of those rates. Those rates are hitting right now, right after a period of uncertainty. And when I think about how much time we have left in our spring season, it takes me to this chart, optimal time to list. We are right around there in May, right around there. So we got until about the second week of June. Okay. June's front loaded. First 2 weeks of June is usually higher than the second 2 weeks of June. So you got to the second week of June, you got about a month, which means if you guys need price cuts, I don't know anyone that's really listing now or like thinking about listing now at the end of the season, but I guess it's always happening. Price cuts over here, guys. The best price cut data I can give you for ammunition for a price reduction. I do see a rise in the median price cut right there, that orange. Let me go to a 3-year chart. Might be a little easier if you guys can see this. 4.7% is the median price cut. 4.7%. There was 1,200 price cuts in April. I don't know how much there were in May so far, but it doesn't look like anything crazy. It looks like it's just in line with this chart. It's just normal. Business is normal. So you have this chart. That's number one. You have the climate index. Definitely go local on this climate index. I was just on with an agent before I came on over here. Was having trouble selling an apartment in a certain sector. I'm not going to talk about it. And we looked at the climate index in that certain sector, and it was way below. It was below challenging. Like it was just a weak market in that sector. So if you have that, you could have another temperature conversation. Maybe that'll help the seller do that price reduction. And then finally, guys, dashboard, infographics, price reduction. Check out what is going on over here. Let's just go Midtown Center. Let's go co-op, 2 beds, whatever it is. Generate the chart, see what's going on, price reduction in that sector of the woods. Maybe that'll allow your seller to, I guess, lose the stigma of price reductions, seeing that other people are doing it. Okay.
That's a great point. I mean, certainly price cuts are nothing new. Everyone hates to want to do it, but obviously there's strength in numbers. I want to revert back to the comments because one came in. I mean,
Sure.
One of the reasons I love doing Macro Monday with you, Noah, is that we get so many comments from so many smart people. And just in general, like some of the conversations are really great. And so someone writes in, and I'll call you by name because you're super smart. I think people should know it. Karen Costa writes in, she says, on my listings, I get lots of calls if the seller would be willing to rent. I think that's super insightful.
There you go. Yeah, there you go. It's an interesting market out there, guys. And you guys are a couple weeks ahead of us. We don't see it until the deal gets signed, really, until the print is made. So you guys are really front lines. If there's a recovery happening right now, I don't see it yet in the data. Maybe you guys feel it. I don't know. But another couple more weeks, we should see it. Okay. That's all I got, John.
I'm keeping my fingers crossed. I really hope we can get May back to seasonal levels, hopefully above. But it's seeming like it's tough. It's Manhattan's doing one thing, Brooklyn's doing another. So got to get these markets back on track.
Yeah, and the buyers need to get ready. Once you hit June and July, all those sellers that didn't sell, that have to sell, that can't tap the rental market, there might be some interesting value opportunities going on there, guys. Use the search listings. Okay, let's do Midtown Center again. Let me show you what I'm talking about. Midtown Center, search listings, and do price reduced. Okay, and then do days on market like over 170 or something like that, price reduced, and see what you're dealing with in that sector. Come back here like June, July, send that to your buyers. If they're still on the market, they might be wheeling and dealing. So good engagement bait.
Huh, that's nice. That's a good point.
Okay. All right, guys. No more questions, John?
Nope. All good. I mean,
Okay.
Look, we're always a little delayed, right? So the question can come in, and if we don't get to your question now, we'll try to get to it in the chat after the fact. But thank you everybody for joining us. This is a lot of fun.
Just email John at UrbanDigs.com.
There you go.
And he'll get back to you. Okay. All right. Thank you, guys. I hope this was helpful today. Always good to talk all this stuff out. We'll be back here next Monday. Thank you, John. Welcome by. I'm Noah Rosenblatt. This has been Macro Monday. Catch you guys next time. Good luck out there, guys.